Can President Trump really force interest rates to go down? You see, this past week was actually a pretty quiet week for mortgage rates, but Trump's bold statement about demanding lower rates has sparked some discussions. So in this video, we're going to talk about whether or not a president can actually control interest rates and what you need to know. Since Inauguration Day this past week, the average mortgage rate really didn't move much. If you look at the data on screen, we have VA rates showing for the average 30-year fixed over the last week just since the 20th, and you'll see that we've been teetering between the 647 651 range, which is very minimal change. Sure, we saw it go up to 655. I think it was Thursday and Friday, but since then we've seen it come back down to the 651, which is within a couple of minor points. If you are looking at FHA, 650 is the average, 15-year fixed 648, and then 30-year fixed conventional 7.07. If you want to get access to this page, is actually a live page, a part of my newsletter that you can actually access, and the link is linked down below in the pinned comment. You can simply check it out, and it gets updated every single day in real time to give you an idea of where the average mortgage rates are. So now we talked about this past week, but now we need to talk about this upcoming week. And this upcoming week, we actually have a pretty big announcement and meeting coming from the Federal Reserve, as they are going to be meeting tomorrow, the 28th and the 29th, with an expectation of an announcement coming on the afternoon of the 29th, which will give us an idea of where they're at with regards to news, data, and also their future plans. So let's talk about the Federal Reserve's role. The Federal Reserve, not the president, directly influences interest rates through policies. While Trump can't directly dictate to the Fed, his policies can have indirect effects on the economy, which in turn can influence rates. So let's talk about the economic impact. Fiscal changes under any administration can lead to changes in economic growth, tax revenues, and government borrowing. If economic growth increases due to policy changes like tax cuts, this might push rates up due to higher borrowing needs for government spending. Conversely, if spending cuts are significant enough to offset lower tax income, the Treasury issuance could decrease, which potentially could lower rates. But this process is slow and not something that realistically could happen in 2025. Another thing to remember is it's not just domestic policy that matters. Global economic conditions also play a significant role. For instance, if there's a high demand for U.S. treasuries abroad, this could push yields down. Events in Europe or economic policies in China can ripple through to U.S. rates. So let's dive into some of the historical context to all of this by going back to Trump's first term. During his first term, we saw markets react to his policies. Post-election in 2016, the anticipation of the tax bill caused markets to brace for higher rates due to expected increase in treasury issuance and economic growth. Rates initially rose in 2018 after the tax bill passed, but cooled off in 2019 as economic data suggested slowdown at home and abroad. Remember, market sentiment can move rates even before policies are implemented. If investors feel that Trump's policies will lead to inflation or economic growth, this can influence bond yields and by extension interest rates, even if the policies themselves haven't yet taken effect. But now the current economic environment is different from Trump's first term. High inflation, strong economic growth, and elevated treasury issuance have driven rates up. Although inflation has decreased, it still needs to move closer to the Fed's target for rates to see significant reductions. Investors' expectation about future inflation can significantly sway rates. Tools like the break-even inflation rate give us insights into these expectations, which directly impact bond yields and interest rates. So let's talk about long-term versus short-term rates. It's crucial to understand that short-term rates, like the Fed funds rate, are not the same as long-term rates like mortgages. They can move differently. For example, if the market expects inflation to rise, long-term rates might increase even if short-term rates are cut. The Fed has more tools than just the Fed funds rate. Quantitative easing, where the Fed buys securities to inject money into the economy, or changing bank reserve requirements can also influence rates in less direct, significant ways. The Federal Reserve is designed to be independent, insulating monetary policy from political pressures. Market expectations show that traders believe the Fed will act based on economic data, not political demands. If we entertain the idea that the Fed could give in to political pressure and cut rates prematurely or excessively, there are still issues. The Fed funds rate only affects overnight lending among banks, while mortgage rates, which are long-term, react with a delay to Fed changes, which means cutting rates without economic justification could reignite inflation, leading to higher rates later as the Fed would need to recorrect its course. Public perception of economic policies can also sway consumer behavior, affecting inflation and growth. If consumers believe rates will fall, they might spend more, potentially fueling inflation. I mean, as someone who works in the real estate industry, not only through this real estate channel, but also in the active practice of helping people obtain a mortgage and also find their future home, I would love to see interest rates come down, but I would also like to see it come down within reason. The last thing that I want is for us to be put in a situation where we're having to bounce back from low interest rates and have them spike rapidly like we unfortunately had to do a few short years ago. My hope is that we learn from that situation and we move in a more strategic fashion that helps the future of our economy be a little bit more stable for the long term. So to answer the question that we started with, can Trump force rates lower? Directly? No. Indirectly through policy? Maybe. But this comes with significant caveats. The best path for lower rates includes controlled inflation, a stable economy, and reduced government borrowing. Let me know your thoughts. Do you think Trump can influence interest rates? I want to hear from you down below in the comments. The last thing I want to leave you with is the most important thing. Jesus loves you and he paid the ultimate price for your life. So if you turn to him, trust in him, and believe in him, he has a beautiful plan and purpose for you. I'll see you in the next one.